Hello, everybody. Thank you for joining us for another in our series of our webinars regarding firm status, investment portfolio status, different things that we have going on, and most importantly, giving you information and remaining in close contact with you. Most importantly, we hope everybody is doing well. We've spoken to many of our clients, and hopefully we've spoken to you. And if not, we want to. So please don't hesitate to reach out to us, and we are reaching out to everybody. I'd like to start by saying that we might have a little technical glitches here and there. The internet seems to be fairly well burdened today, and we're recording this webinar, be passing this out and making it generally available. So hopefully this is pretty glitch free, but if there is something that happens, please forgive us for that. We wanted to make sure we get this out in a timely way. I'm very happy to report that all of our staff are very well. Carrie, our Chief Operating Officer, will be speaking about this, but we're all sheltered in place. We're all remote. We've been doing so for 2 weeks, and things have been remarkably smooth. Most importantly, everybody is doing well, and we're all very well connected. We thank everybody for all of your kindnesses and conversations during this difficult time. And we know that we'll be doing this for some weeks ahead, so we'll look forward to continue to provide information and communication on a frequent basis. I wanted to go over today's agenda briefly. We want to keep this webinar somewhat brief because we know we'd like you to watch the whole thing. Carrie will be providing us an operational update. In the last webinar, we introduced Carrie and talked a little bit about her background. We won't need to do that today. We just want to get into the heart of the material. And then Mark McCarron, our Chief Investment Officer, is going to delve into a market update through up until the recording of this webinar. And we'll be delving into some of the actions that we've taken, as you know, in the portfolio. And we wanted to look specifically today about the fixed income portfolio. We wanted to describe things that we're doing within the bond portfolio for its safety, its security, its liquidity. Mark will provide a lot of information and has also brought in today Gino Nucci from MetWest, who is one of our excellent bond managers, for his insight and what MetWest's insight on the environment, as well as what's going on within the portfolio and some opportunities that are there. Then we'll have our wrap up, and everybody will get about on with their day. So I just briefly, we continue to do client planning. There's long-term projections that we're providing to clients, reminding them, and with new portfolio values, stress testing, investment rates of return. And what we're seeing is that the portfolios are very resilient, that our clients are very resilient. We're happy to do that for anybody at any time. And there's been a lot of portfolio activity, but that was in league with what we had previously described, and Carrie will talk a little bit about those actions. And so without any further ado, I'd like to reintroduce you to Carrie Delgett and have her talk about what's going on within our firm.
Great, thanks, Grant. I'm happy to share that our team settled into a remote work environment rather quickly. It's pretty clear that our investment in technology infrastructure, our defined processes, and our culture of collaboration and communication certainly helped. The reality is we've successfully launched 32 new mini offices from each of our employees' homes. We also benefit quite a bit from having a business annuity plan already in place, something that you hope you never need to leverage, but certainly critical in this time. Our preparations provided for seamless, fluid connectivity with our custodians, our portfolio managers, our business partners, and each other in managing the business and meeting the client needs. A recent example of our operation in action this week, our trade team flawlessly executed 3,000 trades in support of the equity portfolio repositioning that Grant touched on in his opening remarks. So again, I'm just happy to share that all in all, it's really been a great week. With that, I'll turn it over to Mark to provide our investment update.
Yeah, thank you, Carrie. And thanks everyone for your participation and joining in today. What I want to do is just give a quick update on what's going on in the markets through today. These are fast-moving markets, of course. The first thing I want to highlight is really what's going on from a policy standpoint. There's been a massive response by both the Federal Reserve and also U.S. Congress. And we're actually talking to you today sort of about midday on Friday, and we're anticipating that a $2 trillion virus relief package will be passed either today or over the weekend. And stock markets, up until the last couple of days, they've stabilized a little bit. There's been a little bit more up as well as down. And I think a lot has to do with the monetary and fiscal stimulus that has come to bear on the markets. And the third thing we want to do is really talk and dive deep, as Grant mentioned, into the bond markets themselves. First and foremost, there's been support for cash money market funds by the U.S. government. So as we saw in 2008, 2009, the credit crisis, there was a lot of concern for the stability of money market funds. That was one of the first things that the Federal Reserve and U.S. Treasury highlighted, is that there's support for these money market funds. The second trend, I would say, is there's been continued demand for U.S. Treasuries. That's not only by investors, but as we'll get into it, it's going to be a little bit more it's going to be a lot of demand also from the Federal Reserve. And that's really what we're highlighting here. So the Fed is buying approximately $1 trillion in treasuries, mortgage securities, and some corporate bonds. And I think that really has an impact. It has an impact not only on the real economy, but it also has an impact in the bond market itself. And that's really what I want to go to today. First, a quick reminder, Wescott manages two fixed income strategies. One's core and one's tax managed. The core strategies up there on the right-hand side of this presentation. The tax managed, or the investing in tax-exempt bonds, is the second strategy we offer. Both, by the way, are very conservatively managed. We define that conservatism as limited in our interest rate risk and also a modest credit risk. What we're really trying to do is provide stability in the cash and bond portfolios for you, especially when you see such volatility on the equity side. As a reminder, the bond component has always been and remains a critical part of a portfolio for generating income, providing diversification, and really when there's falling prices instead of inflation, it's deflation, bonds can hold their own. What I also want to highlight too is that MetWest, our guest today, is an important part of both strategies. And that's really why we think that their insights today and what they can do in client portfolios is really valuable. And so before we get into that, I want to just set the stage a little bit. If you look at the U.S. bond market so far this year, it's been a wild ride. And when we said bonds, they're not all the same, right? So the U.S. Bond market is made up of government bonds, which are, as we talked about before, in favor and up nearly 20%, 19.5% so far this year. And that's through a few days ago. And that's really benefiting from a flight to safety trade, which is this idea of trying to get out of the way of risk. And the other aspect is, again, it's Federal Reserve buying quite a lot of government bonds that pushes prices up. And by the way, yields down. We'll get into that. On the far right-hand side, we see the real impact of a recession scare, or in fact even a default scare. So high yield bonds, bonds issued by companies that are below investment grade, have fallen 17.6%. That's almost as much as the equity market. And it's really important to note that Wescott's fixed income strategies in both tax core and taxable tax managed have very limited exposure to the high yield bond market, really because of the volatility associated with them. The other two sectors of the market we're going to talk about today are investment grade corporate bonds. They are down. They are down almost 8% through March 25th. But those are investment grade. Those are likely to be, in most cases, stable and survive a recession in the most part, but careful security selection is important. We'll get into that. And then finally, the agency mortgage-backed securities market. We're going to refer to that later too. What that is bonds backed by the U.S. government, but in the mortgage-backed securities sector, they're actually up a little bit this year, 2.5%. Just as a context, Wescott's core bond portfolio is up about 1% so far this year. It's benefited from its allocation to government bonds. We have an underweight to investment grade corporates, and we have very limited exposure to high yield bonds. Again, consistent with that limited credit exposure that we talked about at the beginning. We do, however, have a pretty sizable allocation to securitized bonds, which agency mortgage-backed securities are a big part of. So we're almost there. We're sort of building up here, but the next two slides, this one and the following, what we're showing here is what's called a yield spread. And the yield spread is really the differential in yield between, in this case, investment grade bonds and treasuries. And when it rises, like it did in 2002, like it did very severely in 2008 and 9, and like it's doing today, when it rises, it signals a growing concern about the ability of the underlying companies to service their debt. The last time this yield spread widened to 4%, as it is today, was actually in 2008, 2009, the credit crisis, which was over 10 years ago, but since then has been on a downward descent, if you will, up until only recently. And that's important because that's really when we brought in MetWest, and we're going to talk a little bit about that. MetWest was brought into client portfolios in 2009 and mid 2009, in fact, and was able to take advantage of this opportunity. And then, I would say within the investment grade bond market, careful security selection, which bonds you choose, really provides a great opportunity for value added. So we're excited to talk about that shortly. The other thing I would highlight is that in the high yield market, this is the same sort of picture, same type of graph, but I would just note that the axis here is indicating that there's a 10%, over 10% spread between the bond yield in the high yield space and treasuries. What that really means is that as an investor, you're demanding a lot more compensation for buying into these bonds because the future, short-term and intermediate term, is unknown. And as default risk rises, so too does the yield on these securities, and that's why you saw the decline in the price as you did. So with that as a background, it's our great pleasure to introduce and have Gino Nucci from MetWest join us. A couple quick introductions. First of all, MetWest, headquartered in Los Angeles. So Gino is up early with us today. The firm itself has over $200 billion of assets under management, so it's a big global firm. The fund we're investing in and you're investing in has over $80 billion as of yesterday. So it's a very stable and strong fund. The fund itself was the inception date of this fund was back in 2000. So it's seen its good times and bad times in the market. And as I mentioned before, in July of 2009, MetWest Total Return was added to Wescott portfolios. So it's my pleasure to introduce Gino Nucci. He's a managing director with MetWest. A quick background on Gino. He's a senior member of the firm. He's been there since 2004. He's served in a variety of roles, including portfolio manager with in many areas, but in high yield bonds in particular. So I think his insights will be very, very valuable. He's also got a BA in economics from Yale University and got his MBA from UCLA. So I think he's well qualified, really to give us a sense of what's going on here. How does it compare to previous crisis periods, and what opportunities that MetWest and Gino see going forward. So with that, welcome, Gino.
Well, great. Thank you very much, Mark. Appreciate the introduction, and hopefully by the end of today, we'll be referring to some exciting opportunities in fixed income markets. I'm usually the boring bond guy, so it's nice to have some things to talk about for once.
Yeah, we've had some excitement in the equity market, and in fact, as we tried to show beforehand, in the bond market. So again, thank you for joining us. We really have three major areas that we want to get into with your insight and perspective. And maybe first I'll start, I've already referred to this before, but just how has the recent policy actions, particularly by the Fed, what they've done and the size of what they've done and the importance, how has that impacted the bond market? And perhaps you can give us a sense of how that differs from previous Fed action you've seen in the past.
Sure. So maybe what I'll do is very briefly describe our economic outlook, and then dive into what's been a pretty amazing policy response. So first of all, I'd say we're more value investors, so we tend to be a little bit early to sell and then early to buy a little bit, because that's just how value investing works. And for some time, we had thought that late cycle fundamentals were apparent in the U.S. economy long before the virus impact hit. Leverage was very high across U.S. corporate sectors, above past cycle peaks. It seemed a lot more like a 1998 to 2002 scenario, though, where the consumer was very strong. Globally, manufacturing arguably was already showing some signs of decline. And I guess what nobody really anticipated is that the virus would be the actual catalyst to trigger recession-like conditions, similar to perhaps what we saw in the Gulf War in 1990 and, of course, 9/11. So I think initially we were assuming this was very similar to a 9/11 scenario, but I would say over the last week it morphed a little bit into some scenarios that felt a lot like 2008 from a liquidity perspective. And I think that the long and the short of it is that you had three things occurring at the same time. Number one, there were margin calls, particularly in mortgage REITs. We could talk a little bit about that. Secondly, there were outflows. I think there were $200 billion in outflows over the last 2 weeks from bond funds. That's 7 times the prior record. So a lot of pressure to sell those assets. And then third, we had a lot of pension rebalancing. So I think when you take those three things combined, what you had was that everyone was trying to sell quote unquote safe assets all at once. And, I'll use the old theater analogy. Everybody was trying to get to the exit at the same time, and it just was too small for everybody to get out at the same price. So what happens when you have a bit of a panic? I think the good thing about that is it cues the response from a monetary and fiscal perspective. And so monetary policy, certainly was the first to kind of step in here. And if you think about what they're dealing with here, they're dealing with a massive deflationary shock, which Mark alluded to earlier. Not only have you had the virus impact, but you also have a strengthening U.S. dollar and oil declining as well. So those three things collectively have produced a massive shock. And so, of course, they're trying to offset that with some inflationary actions. thus far, we've seen very aggressive action by the Fed. We think it's going to take some time to stabilize the economy. It doesn't happen right away. But as expected, they initially rolled out, call it an alphabet soup of programs. And what these programs were designed to do initially, I think, is to heal the higher quality parts of the credit markets. Because if those areas of the market are not functioning, then it's very difficult for the economy at large to function properly. Central banks have, we would argue, probably limited firepower given how low rates are and the balance sheet. But that said, what we've seen from the Fed has been, quite remarkable. The balance sheet's gone from a little under $4 trillion to in excess of $5 trillion. I think it was $5.3 trillion as of the other day. And so effectively what they've been doing is buying more on a daily basis than they did over a 2-month period at the height of quantitative easing during the last crisis. So pretty amazing. I think we'll see a lot more new creative solutions over the next several weeks. And that said, I think this is a battle they're going to win eventually because they can throw a lot of firepower at fixing some of the higher quality areas of the credit markets.
Yeah.
You also mentioned fiscal policy.
Yeah.
Assuming everything happens today and we get to $2 trillion of fiscal policy, that's substantial. It's 10% of GDP, more or less. It's the largest ever, I believe, outside of a war period. And so, if you think about the U.S. economy, which is about 20 trillion in size, so about 5 trillion a quarter, more or less, they're trying to offset about half a quarterly GDP. So we might see more of that going forward, but initially, that's a very substantive reaction by Congress. And despite the bickering, they've actually gone and done this pretty quickly. And I guess from our perspective, it's probably long overdue, but especially so in this case. And that's because we're definitely going to see pent-up demand in a lot of areas in the economy. So people are going to get back on airplanes. People are going to buy cars again. All those are going to come back at some point. However, there's some things that are not going to come back, right? You're not going to go get 2 haircuts next month or have 5 dinners at your favorite restaurant. And so I think the combined impact of both of these is that, I think we've avoided the disaster scenario, so to speak. That said, there's still a very high probability of recession priced into a lot of the fixed income markets.
Yeah. And maybe with that, I can just ask you, following MetWest and the way that you're managing the portfolio, the total return portfolio, it's been clear that the strategy has been to be pretty limited on the exposure you're taking to lower quality investments. The last many years, the spread you're given or the yield you're given to take that bet has been pretty low. That's both on the investment grade side and the high yield side. But what does this environment provide in terms of maybe opportunities to take advantage of that or continued risks that you're looking at?
Well, maybe what I'll do is briefly sketch out our view on fixed income markets, and then we can get on a more granular level a bit later in the discussion. But overall, obviously, from a humanitarian perspective, this is awful, and nobody likes going through this, of course. But as value investors, we've been preparing for this, and we've been through multiple deleveragings over time, over the last 30 years. And so we came into this underweight corporate bonds, similar to your overall firm policy, and overweight securitized bonds, just because we thought there was a lot less volatility, I should say, there, and then neutral on interest rate risk. As we've gone through this process, maybe I'll just kind of go through each market very briefly and describe what we're seeing and our view on it. And so with the Treasury market, obviously Treasury markets have done really well. And it's really interesting. I think the rate markets are trying to adjust to a world of 0% short rates and very high liquidity needs juxtaposed with a massive fiscal stimulus, which usually all else equal leads to higher yields. The long end of the curve is probably going to be the most volatile going forward as the Fed anchors the front end. And the front end, for the most part, should be relatively less volatile going forward, in our opinion, just given all the QE and what the government is doing to essentially buy those assets. Given all of that, right now we've moved from neutral to a more defensive posture on interest rate risk. So, in other words, we're a little bit short duration or underweight our duration in our portfolios, and that's just, again, I think a view that over time this will get fixed, and when we come out of it, we could see higher yields as the economy improves. Mortgages have been very attractive. So I know we have a slide at the end of the presentation which kind of goes through this a little bit. And
yeah, I've just brought it up.
This was the area that I think we were very aggressive on initially, and we think it's very attractive given the wide spreads you're seeing. There is this very high quality, probably the most liquid part of the fixed income market. You can trade a $500 million on the wire at very low bid-ask spreads. So that's a sector that we continue to like, and probably most importantly has tremendous Fed sponsorship given that QE for mortgages has been resumed. Investment grade and high yield corporates have been an area that I would say, of course, we were very selective on coming into this and underweight. That said, spreads are now wide of 300 basis points, as you saw on the graph that Mark was referring to earlier. This is wider than the 01 and 91 recessions, not quite to 2008 levels, but that said, whenever you get to valuations like this, you can have very, very attractive returns. So we've been aggressively adding there. And then to your point on probably the lower quality areas of the market, we've been slowly wading into these areas of the market. They're starting to look very attractive, and so what I'm referring to is probably high yield bonds and emerging market credit as well to a certain extent. We think that those valuations are starting to look very compelling, but there's still some downside volatility that exists because, for example, in the corporate sector, we've already started to see a lot of downgrades into high yield from investment grade, and we think that's going to continue to play out over the next quarter or two. And another thing to consider as well is that in contrast to agency mortgages, which the Fed is explicitly sponsoring now, the Fed, as you probably know, is not going after these lower quality areas of the market. They're not buying high yield bonds, for example. So I think that's, in summary, that's kind of the view on each part of the fixed income market right now.
That's great. And maybe in the next minute or two, talk a little bit about maybe some specific actions that MetWest has taken in the portfolio, whether it's taking advantage of the higher yield or other areas. You talked about the sectors, but maybe a few examples of securities as well.
Great. Yeah. So very quickly on the sector side, agency mortgages, which we're talking about, we increased that from 30 to 50%. And the thought process there was that Fannie and Freddie mortgages are very attractive, and our belief was that the Federal Reserve was going to resume QE in mortgages first. That turned out to be the case. So those spreads widened from 70 to 180, and they've since come back down to around 110. So that's been a successful trade thus far and has worked out really well. Corporates, we've added about 10% in the portfolio, primarily, I should say almost exclusively in investment grade. And I think over time, what you'll see us do is we'll harvest some of those gains we've been getting in the agency mortgage area if spreads continue to perform well, and redeploy it into corporates, and perhaps even lower parts of the capital structure and securitized, but not quite yet. Specific opportunities, it's again, it's not often you hear a bond person get all excited, but we're really excited right now. There's a lot of opportunity in the corporate area specifically. So, for example, right now you can buy large money center banks. So that would be a Goldman Sachs, JP Morgan, Citigroup, at anywhere from plus 2.5 to plus 3% yield premiums over relevant treasuries. CVS is another good example. You can buy that at nearly 3% yield premiums right now, and that's, I would think, a very stable area of the market. AT&T, Charter, these are all trading right around 3% to maybe even, in Charter's case, 3.5% over relevant treasury bonds. And what that means from a potential return perspective is that for a 10-year corporate bond, you could see over the next year, let's say, if spreads remediate and go back to the average, you could see high single digit, maybe low double digit type of returns, which is amazing relative to what we've been getting here recently. And for a long bond, you could see returns in excess of 30%. So significant, almost equity-like type of upside right now in corporate bonds, which we don't get to see that often in our world. And again, I think that's why we're excited about it. Now, overall, in a scale of 1 to 10, we get asked that question a lot. Where are you? And I would say where 1 would be very defensive and 10 would be very aggressive, we're probably at a 6 or 7 right now. And that's just because our view, having gone through a lot of these deleveragings, and we don't know how this is going to play out. It could be that we have a quick V-shaped recovery, but I think our base case is that the typical arc of a credit cycle is you have a panic. We've already had that. Then you get a policy-induced bounce, and it seems as though that we're on our way towards that bounce, which usually lasts a couple weeks. And then you have some sort of a retest later when you have some things occur, such as downgrades or maybe some defaults. And I think that would be the time period where then we would get maybe to an 8, 9, or 10 with respect to being aggressive in terms of how this typically plays out. At least that's our crystal ball. Of course, I'm sure we'll be wrong, but it's really hard to predict the future. But that's kind of our base case.
Very good. No, I really appreciate your insights, perspectives, some of the changes and actions you've taken in the portfolio in this environment. And if I could just sort of bring it back to, this is why we have MetWest in your portfolios. This is what they did initially in July of 2009. They've done that throughout the last many years, and they're doing what they're supposed to be doing today. So with that, thank you, Gino, very much for coming on the call today and giving us your perspective.
My pleasure. Thank you very much for your sponsorship and everyone's time today.
Great. So with that, I'm gonna turn it back over to Grant for some closing remarks.
Thanks, Mark, and thanks very much for your presentation. And to Gino, thanks very much. Really, really appreciate that. Was so helpful and exactly what we were looking for. In basically, it's similar to what we heard last week when Mark was talking about the importance of having prepared for this by the portfolio changes that were made, and that gives us the opportunities that we have executed on this week. And as Gino was talking about, opportunities that they've been able to take advantage of now and opportunities that they see developing in the future. So thanks very much for both of you for that. Was really helpful for an important part of our portfolio, our bonds, which we always look at as a bond as a promise to repay what we've invested. The principal is returned when we invest in a bond. So having high credit quality, having a good yield, and having liquidity are really important in the bond portfolio. A couple of other takeaways, all are well. We've been talking to our clients. We've been working with our clients, as I said at the beginning, and we look forward to doing more of the same. Operations are really continuing extremely smoothly, and we look forward to keep up all of the activities that we normally do, whether that's money movement or anything involved in the portfolio. Carrie has been in contact with all of our custodians, Schwab, Fidelity, Pershing, TD, other places where our clients' monies are, and have gotten the inside view of what's going on there. and making sure that all is good as it is. And we look forward to more of these communications. We've been, making sure we have a comprehensive email during the week talking about portfolio actions and also, what's going on in the market. And we'll look to continue this type of format in a webinar, inviting again a portfolio manager to talk about what things that are happening from within their portfolio and then the world as it is from their vantage point. So with that, from us, all of us, this is, as I said last webinar, this was from a retreat seems like forever ago, but it was 2 weeks ago. And where we had wind that this was coming and we all gathered to execute on the planning for it. To your family, we hope everybody's well and continues to be well. Be safe. We thank you very much, and do not hesitate to contact us for any reason at any time, and we'll continue to be in contact with you. Thank you, everybody.